Hello everyone, welcome to BISP Solutions. BISP Solutions is a tech company that provides technical solutions across the world. So let me start with a small question with you all. That have you ever tried planning your expenses before a wedding or calculated how much EMI you will have to pay before buying a car or a home? So if your answer is yes, then congratulations. You have already done a basic version of financial modeling. You just didn't recall it that. Right? So financial modeling is not about just complicated Excel formulas or Wall Street suits. It's also simply about planning your money with logic, using numbers to answer real questions like, will this idea make profit? Should I take a loan or not? And will I run out of money after 6 months? If that is so, today we are not here to learn finance like a textbook. We are here to learn to think like a smart business owner or investor, someone who doesn't just learn and earn money but also make decisions with money that multiply wealth. So let's decode financial modeling together in the simplest, most practical way possible. So in our previous session we have covered topics like DCF modeling and why is it important, key concepts of DCF modeling and what is present value, future value, annuity, perpetuity, what is terminal value, Gordon growth method and exit multiple method, and also understanding risk, growth and cash in DCF, and what is WACC and its importance and cost of capital. And also we have understood basic introduction like beta, market return, market reversion, etc. like that. So in today's session what we will be learning about WACC and its importance in our financial modeling, cost of capital, risk-free rate, investors and dividend yield and buyback yield, total shareholder return and regression, beta regression, bottoms up beta and retained market. So why we will be learning that? Because as we have understood the basics of financial modeling, now we will be moving forward to our advanced level of our financial modeling. So first of all, what is WACC? So WACC tells us how much it costs you to get money for your business. So whether we are using our own money, which is our savings, or investors' money, or borrowed money like a loan. So it's like asking that on an average how much interest or return do I need to give to people who gave me money for loan or investment like that. So for example, as we are using 1 lakh rupees for our own money as our own money, which is called as savings, and we have took a loan from a bank at 10% interest of the same amount, which is 1 lakh rupees, then we must earn more than 10% to pay the bank, because our interest is 10%, plus we expect to earn something from our own investment too. Maybe we can expect 12%, because 10% we are giving to bank, so from 10% we have to increase it to 12%. So now combining these, we will be getting our average cost of capital for the same. So this is what our WACC means. So if we look to our formula of WACC, which is E upon E plus D into RE plus D upon E plus D into RD into 1 minus tax rate. I assume that you all didn't get this, but starting with the explanation of the same, equity, which is our money only, debt is the loan, and RE is the cost of equity, and RD is our cost of debt. So now we will be moving forward. What is cost of capital? So it's the total cost of arranging money, which is loan plus own amount, and if my business earns less than cost of capital, it's a total loss for me, and if it earns more, then I am in profit, right? This is what our cost of capital means in a simple way. Then in cost of capital there are two heads, which is cost of equity and cost of debt. So first we understand about what is cost of equity. So it's the return we expect to earn on our own money, thinking of it as if I put 1 lakh rupees in my business instead of keeping it in FD or property, how much should I get in return to make it worth it, right? So if my business doesn't give at least that much return, I might as well invest it anywhere else, right? Then comes what is cost of debt, which is the interest we pay on a loan. That's it. So if my bank is giving me 1 lakh at 10% interest, then my cost of debt will be 10%. But remember one thing, that we also save some tax because interest is allowed as an expense. So actual cost will be 10% into 1 minus tax rate. And in long run, always business take 25% to 30% as their tax rate. Then comes our what is risk-free rate. So imagine putting money in a government saving schemes, or we can say FD in SBI. There is no risk and there is a CD return we are getting, right? So let's say government bond gives 6%. That's our risk-free rate. So this government bond is our RBI government bond, which gives a 6% interest rate without any other charges, and it is also risk free, that a person will be getting minimum 6% rate of interest on the bond he has taken, right? So this is like the minimum return you would expect from any investment where you have done, right? Then comes our who are investors. So anyone who gives us money to grow your business and expects a return. So it can be ourself also, and friends or family investing, or bank giving us a loan, and private investors there, and they all want profit in return, right? Even we are starting a business, so we also expect some profit to be earned from that particular business. So we also want profit in return. So we are also investors in our business. So now what is marginal return? So it's the extra return you get by using one more unit of money. For example, we have invested 10,000 and earned 2,000 rupees of profit. So it is like 20% of our investment, right? And next we have invested 1,000 rupees more and earn 300 rupees profit. So 30% will be there, right? So that 30% extra is our marginal return, right? So what is dividend yield? So it means how much cash, which is dividend, a company gives back to its shareholders from the share price. So if I buy a share of 100 rupees and the company gives me 5 rupees as dividend, so my dividend yield will be 5% only. Okay. Then comes our what is buyback yield. So sometimes company buy their shares back from their people. It's like giving money back. So if I had a share worth rupees 100 rupees and my company buys it from me only for around 110, that 10 rupees is the buyback yield for the company, right? Then what is the total shareholders return? So it means dividend plus increase in share value plus buybacks. All these are gains for investors. Total return tells us how much investors earned in total. Then comes what is beta. Beta tells us how risky our business or investment is compared to the market. So if beta is equals to 1, then same risk as market. If beta is more than 1, there is more risk, and if there is less 1 for beta, it's less risky for us. So for an example, if market goes up by 10% and our business goes up by 15%, my beta will be higher than 1, right? If it only goes up by 5%, my beta is lower than 1, right? So this is what our beta means. Then comes our what is regression approach in beta. So it's a math calculated to how much our business changes when the whole market changes. In simple words, we can say when the market moves, how much do we move? So in this, after this, what is beta regression? So this is when we actually use past data to draw a line that shows the relationship between market changes and your business or share changes, right? In simple words, we can say when the market moves, how much do you move, right? So after that, what is bottoms up beta? Here we don't look at market data, right? Instead, we look at similar businesses, take average beta of those particular businesses and adjust it for our business, and then we will be using it when we don't have enough history of our business or our business is new, right? So after that comes our what is market return. So it's the average return the stock market gives every year. Let's say Nifty or Sensex grows up by 12% per year, then market return is 12%, right? So this helps us to decide if your business is doing better or worse than the market. Then comes what is mean reversion. So this means if something goes too high or too low, it will come back to average, which is mean. Like the trend graph, you all could see that this way the graph is going on. Here it was minimum, then maximum, then it got slightly declined, then it slightly got increased, again it slightly decreased, then increased, then decreased, and it after that it will be steady, right? Then comes our example for the same is a stock price went up a lot, but it comes back down later on. A business had a bad year, it bounces back later. So in this picture you can see that one time it was earning good amount, but after that there was a fall, then again it recovered it, then again that particular business earned loss, then again profit, then loss, and then the steady growth was there, right? So in this curves there might be a small changes, like here it got its break even point, then it increased, then little by little they got loss, and after that the same pattern will follow in mean reversion. So it might happen there also. Then comes what is retained market. So this means keeping our customer with us, not letting them go to the competitors. So if my tea stall has regular customers, we are retaining our market, right? This is what our retained market means, because they will only be giving us the business which we want for growing and staying in the market for longer run, right? Then why not use normal regression? Because in finance, normal regression might not capture risk and volatility properly. So we use beta regression or bottoms up approach for better accuracy, right? Then comes our case study for the same, right? So Ramesh owns a kirana store and he used 2 lakh rupees as the savings, which is the equity for us, right? Then he borrowed 1 lakh rupees from the bank, and in that 1 lakh rupees he is giving 12% of interest rate. So in this case our cost of debt is 12%, right? Then he wants to know what return should I make to stay profit, right? So let's assume cost of equity is 15%. I'm giving a hypothetical situation over here because our cost of debt is 12%, and we have already discussed in above example that if we are taking a loan of 10%, so we should earn more than 10%, right? Then only our business will be in profit. So I am taking cost of equity as 15% and tax rate as 25%. I have also mentioned that in longer period, if a business is going, so they will take tax rate as 25% to 30%. Now I have taken tax rate as 25% as a hypothetical tax rate. So if we calculate our WACC, so my equity was 2 lakh rupees, so I will be giving it or I will be mentioning it in my formula as 2, because just to make it easy, and 1 lakh is my debt, which is the bank loan I have taken at 12% interest rate. I will be mentioning my 1 lakh as 1, right? And if I calculate my WACC, so what I have done over here, I have taken my equity divided by 3. 3 why? I have already discussed in my formula that we will be adding our equity and debt. That's why 3 is there, and I will be multiplying it with my cost of equity plus 1 by 3. 1 is our 1 lakh rupees of bank which we have taken, and cost of debt, which is multiplied by 1 minus tax rate, which we have already discussed in our formula in PPT. I have already explained it. Then when we calculate it, it gives us 13%. So Ramesh should make more than 13% return on his business to stay in profit, right? So that is what our case study gives us a solution of calculating WACC. So now what we will be doing, we will be taking it in another step of calculation. Like we will be taking our automobile companies with different data set. So what I have done, I will be opening my WACC data sheet, right? So I have taken my 5 companies which belong to FMCG. So I have taken Hindustan Unilever, ITC, Nestle, Godrej Consumer Products, Tata Consumer Productions, and Imami Limited, right? And they have operating country as India only. My total debt. So how I calculated my total debt and total equity and tax rate. Tax rate will be the same as it is, right? I have already mentioned in my previous sessions, and today also I have mentioned in everywhere, that if we are running our business on long run, then we will be taking our tax rate as 25% to 30%, right? So now coming to our total debt and total equity, you all must have been confused that how I have taken this total debt and total equity. So what I have done, I searched in my Sreener.in about my total debt of the company name Hindustan Unilever. So what I will be doing, my Hindustan Unilever Limited is there. What I will be doing, I will be coming down. What I have to take total debt, which is our borrowings only. So how I will be taking my borrowings from here? I have taken 46. I have just written as 46 only. No formatting will be done over here, right? Then now I have to calculate my total equity. So for total equity, what I will be doing, I will be adding my equity, share capital, and reserves. So my equity capital and reserves are there. So when I calculated them, it gives me 3537 rupees or total equity. These all are in crores, not in smaller figures. They are in crores, right? So like that only I have taken for ITC, Nestle, Godrej Consumer, and Tata Consumer, and Imami Limited, right? And tax rate will be common for every companies over here, right? Now coming to my WACC of company, what I have done, I have copy pasted this same data over here, and tax rate is 30% only, which I have already mentioned in my data sheet also. Now if I want to calculate my debt upon equity, what I will be doing, I will be dividing my debt with my equity. It will be giving me 1.30%, and I will be dragging the same formula from my Hindustan Unilever to Imami Limited. Then I want to calculate my debt upon capital. So what I have done, I have calculated it by taking my debt, which is 46, divided by capital. What capital? I have added my total debt and total equity, then I will be getting my capital. So my debt upon capital will be 1.28%, right? And here I have taken levered beta as 1 so that to calculate it evenly. So that's why I have taken levered beta as 1 in my whole sheet, right? So the same formula for debt upon capital, I have dragged it till the Imami Limited, because the same formula will be applied in every companies, right? Then I have to calculate my unlevered beta. So for that, what I will be doing, I will be calculating my unlevered beta by levered beta divided by 1 plus 1 minus tax rate, which was in WACC, if you all remember that, 1 minus tax rate, and I will be multiplying by my debt upon equity. So then I will be getting 0.77 percentage as my unlevered beta, and the same formula will be dragged it till the Imami Limited, as we have calculated our debt upon equity, debt upon capital. Levered beta was also there with us, so unlevered beta we have to calculate, and one calculation is done, so you can drag it till the end of the company you have taken. Then if I want to calculate my average median, so for tax rate, what I have given function over here as average, where I have taken these 6 companies tax rate, which is 30%, and then I have dragged it till the unlevered beta for average out. So debt upon equity was 17.45% of average, and debt upon capital was 12.27% of average, and levered beta is 1 only, because every single company was having 1 levered beta only, so our average comes out to be 1, and unlevered beta we got our 0.10, right? Then again, what formula for median function is available in our Excel sheet. So for that, again, I have selected this data, and I got 30% as my tax rate only for median, and I have dragged it till the end of my unlevered beta for calculating median. So for debt upon equity, I will be getting 8.05%. For debt upon capital, I will be getting 7.09%. Levered beta will be same as 1, and unlevered beta will be 0.05. This is what our peer comparison of different companies' debt upon equity will be like, right? As I have taken this hypothetical situation, and this is also hypothetical, we can say, but we can also say that this is globally known, so this cannot be hypothetical, right? Then coming down, if I want to calculate my cost of debt, okay, so I have taken pre-tax cost of debt, so I have taken 8.40% as a hypothetical figure, and my tax rate is already 30%, which is also a hypothetical situation, or we can say it is already taken by every company who are working in long run, right? So if I calculate my post-tax cost of debt, so how I will be doing, I will be multiplying my pre-tax cost of debt from 1 minus my tax rate. So I will be getting my pre-tax cost of debt as 5.88%, right? Then coming to our cost of equity, so I have taken cost of equity. Inside that, I have taken risk-free rate as 6.50 for example, and equity risk premium, which is ERP, which we will discuss in our next session about it, which is 8.50, and levered beta is 0.072. So if you all are very much confused that how I have taken levered beta over here as 0.072, so I will be calculating it over here. So levered beta over here, as it is asking me comps median unlevered beta, so I have taken my unlevered beta as 0.05 over here. Then target debt upon equity is need to be understood. Then after that, tax rate is 30%. So if I want to calculate my levered beta, I have to calculate my capital structure first of all. After cost of debt and cost of equity, you have to calculate capital structure, because in my some places the data is missing, like levered beta and target debt upon equity. So for easy working, what I will be doing, I will be taking my total debt and market capitalization. So I have taken 17,440 as my total debt, for example, and 32,265 as my market capitalization. So my current, how to calculate current, is total debt divided by my total capital. So I will be getting current as 35.09, and same formula will be applied to my market capitalization. So every total of the capital is 100% only, right? So my target, I don't have this, but I have to calculate that. So what I will be doing, I will be taking this target amount as hypothetical, which is 42.50%, and I will be deducting 42.50 from 100%. So I will be getting 57.50%. So this is what my capital structure is made of. Then I will be calculating my debt upon equity. So for that, what I will be doing, I will be calculating it through my current, total debt upon market capitalization, and when I enter it, it will be giving me this big figure. So I will decrease the amount and right. So we will be getting debt upon equity as 54.05%, and again the same formula will be applied to my target capital structure. So I will be getting target debt upon equity as 73.91%, right? So once this is done, so we will be coming back to our levered beta, and it is asking us target debt upon equity. So we have our data as 73.91. So I will be linking it with my data debt upon equity. So I will be getting my levered beta as, I have calculated it by COMS median unlevered beta into 1 plus 1 minus my tax rate into my target debt upon equity. And once I enter it, I will be getting my levered beta as 0.072, and then I will be linking my levered beta with my cost of equity. So it will be giving me cost of equity as 7.11. How to do that? I have added risk-free rate and my ERP, which is equity risk premium, which will be multiplied by my levered beta, which is 0.072. So I will be getting my cost of equity as 7.11%. Then comes my weighted average cost of capital, which is very important to calculate. So my debt, where I have taken total cost and total weight, so my debt is 5.88 where I have got it. So I will be moving upwards. So I am getting my debt from my post-tax cost of debt, which is 5.88%, and my total weight, which is 42.50. I have already taken the target debt, which is hypothetical situation, so I have linked it with that. Then it is asking me equity, so I have taken my equity as cost of equity over here, and my equity, which is total weight of my equity, which I have taken from my target one, right? Then I want to calculate my WACC, which is weighted average cost of capital. So how to do that? I have taken my sum product function, and I have calculated my total cost and total weight array, and when I clicked on enter, it will be giving me 6.59% of weighted average cost of capital, right? So you must be wondering that I have given 1, 2, 3 with superscript. So I have mentioned it also over here that tax rate considered as marginal tax rate for the country, which was 1. Levered beta is based on 5-year monthly data, so it was 2, and unlevered beta is equals to levered beta divided by 1 plus 1 minus tax rate into debt upon equity, which is 3rd, and 4th is levered beta is equals to unlevered beta into 1 plus 1 minus tax rate into debt upon equity, right? So don't get confused in these formulas. In our next session we will be discussing about it in details, so that you will be getting all the things which might be very confusing for you all, in today's session, right? So with this thing and with this particular WACC which we have already calculated, we are analyzing WACC using real data from Indian companies like Hindustan Unilever, ITC and Nestle India. So this comparison helps us understanding how much of their capital is funded by debt and how risky their businesses are based on beta. So for example, our Hindustan Unilever beta has almost no debt, so its capital is mostly safe equity. That's why its debt upon equity ratio is 0.013. Okay, so meaning they can borrow just 1 rupees for every 100 they own, right? So we also see their beta is 1, which means the company's stock moves equally with the market. But when we move the effect of debt, the unlevered beta is just 0.007%, showing the business itself is very stable. So this type of analysis is crucial for investors, analysts and finance professionals who want to calculate WACC and decide whether to invest in the company or not. So in WACC, we need this kind of data to get the correct cost of equity and cost of debt, which are combined in a weighted average formula to know how expensive it is for a company to raise funds. And also the more risky the company, which is high beta, more debt, the higher their WACC, and the higher the WACC, the more return the company must generate to be profitable for investors. So with this data, we learn that understanding how much it costs to arrange money for your business, whether it's your own savings or bank loan, it's just as important as running your business itself. So that's exactly what WACC help us understanding. So no matter how big or small your business is, the moment you understand the cost of money, you stop guessing and start planning about it. So thank you for joining today's session. Keep asking questions, keep learning, because when you understand your money, you control your future.